Hey, it's Mike over at Cross Country Mortgage, and it's Monday morning, time for your Monday morning mortgage update for the week of August the 5th. Hope you all had a great weekend. Gail had a wonderful weekend, just spent some time with friends and relaxed. So let's talk about what happened last week, what's going to happen this week, how it's going to impact the market. You can have those intelligent conversations with your buyers and sellers because they're going to ask a lot of questions because it was a big week last week, ending on Friday with a big rate improvement. If you haven't heard about it, big rate improvement. I want to show you visually what that looks like. So let's look at the trading of mortgage-backed securities in the bond market. I show you this graph all the time. Basically, when interest rates for mortgages are put out there every morning by lenders, they look at the trading of mortgage-backed securities in the bond market to determine the pricing of those rates. So when we talk about interest rates, we talk about the rate itself and we talk about pricing. And anybody can quote a rate, but what's the cost of that rate? What's the discount point? And that's the pricing, and that's what this represents. So it shows trading of mortgage-backed securities in the bond market. Each one of these graphs represents 1 day of trading. When we see the graph move down, that means money's flowing out of the bond market, mortgage rates are going up. When we see the graph move up, that means money's flowing into the bond market and mortgage rates are going down. So you can see since May of this year, we've seen a nice gradual improvement overall with some blips of worsening, but really the last 2 weeks, big improvement, over 100 basis point improvement. So let's put that in context. Let's say 2 weeks ago today, I quoted you a 7% interest rate and it costs you 1 discount point. So that's 1% of the loan amount for the borrower. If it's a $100,000 loan, that's $1,000. If it's a $500,000 loan, they're going to pay $5,000 to get that 7% rate. Now today, if I quoted you that same rate, it costs nothing. The pricing for the interest rate has improved. So that's a big improvement, over 100 basis points, which is really translates to 1%, 1 discount point improvement in 2 weeks. We'll take it. Is this a shift? It is. Is it indicating that maybe rates are going to continue to improve? It does. So 2 things caused this: the Federal Reserve's meeting last week and the jobs numbers that came out. So the Federal Reserve, they meet every month and a half. They start their meeting on a Tuesday, they end it on a Wednesday. They come out and say, hey, this is what we said, and then Jerome Powell has a press conference. So what they said in the meeting really is no different than what they've been saying for quite some time. They're going to basically focus on data, and data is going to drive how they'll treat mortgage rates or I'm sorry, the Federal Reserve rate. So when they cut that Federal Reserve rate, they'll cut it because inflation's getting under control and there's signs of a weak economy. And that's what we saw last week. Inflation numbers came out the week before, showed signs of getting under control. And then on Friday, a lot of jobs numbers came out throughout the week, but really Friday showed fewer jobs added to the economy, a lot lower than expectations. On Thursday, they had more jobless claims. The unemployment went up to 4.3%. So all of this showed signs of a weakening economy, and that just triggered bond traders and investors to put money into the bond market because weaker inflation is good for rates, and a weaker economy is good for mortgage rates. And those 2 things came to a head last week. So what are we looking at this week? One thing, basically, it's kind of driving the bus, and that's what's happening in the Middle East, the geopolitical. There's really not a lot of economic data that's going to move the market. Maybe one thing, we'll talk about that, but mostly the uncertainty in the Middle East. And so is it going to be war? Is Israel or Iran going to respond to what's been happening in a big way or a soft way? And that really will determine what people do with their money. If this is a big response, invasion, bombs, again, a big escalation, generally what's going to happen is foreign investors are going to park their money in our safer bond market because it's a flight to safety. They don't want to take any risk with their money because of the unknowns and the volatility of what's happening over there to really move global markets, and it absolutely could. In so many ways. And so they'll park their money in our safer bond market, and that'll be really good for mortgage rates. Money will flow into that bond market. If it's a soft response, cooler heads prevail, we could see some money moving out of that bond market because we've been on such a rise. There'll be kind of an equalization in the market. So a lot of really is unknown right now. We'll be watching what's happening really daily with this developments in the Middle East. Second thing is a treasury dump. The U.S. sells debt every single month to raise money to pay its debt. And is there going to be an appetite for these notes and these bonds? If the unrest in the Middle East escalates, then again, people are going to not only put their money in the bond market, but they're going to buy more of our debt. There's going to be a bigger appetite for that US debt that they sell every month, and that's going to be positive for mortgage rates. The second thing, or the third thing, if you will, is ISM servicing. So basically, we look at two numbers that come out every month. Manufacturing numbers are businesses making stuff, and we've been in a manufacturing recession for 18 months, a very long time. And then servicing, really, all the service industries that have really held up our economy. Last month, it was very weak. It was a number below 50. Today's reading came in and it was above 50. So if we see 2 months of those under 50, that is an absolute indication the recession is on the way. So expectations would have been below 50, but it came up above, and we saw a little bit of a worsening to rates today. Not much, but you can see this red graph here. This is a live feed. So it started out positive, and then those numbers came out, the market reacted, and we ended, we're not ending, we're just in the middle of a little sell-off in the bond market, which could cause mortgage rates to just creep up today. So what are we looking at this week? Again, not a lot of economic data that's going to drive the market, just a lot of uncertainty in the Middle East, and we'll be looking at that uncertainty and the volatility that's going to cause every single day. We're floating into this week, again, watching the market daily, and we'll lock our clients when we see any type of a shift or move. If you have any questions about the rates, don't hesitate to give me a call. If you know somebody that could benefit from this video, please forward it to them. If you have a client that is concerned about the lender they're working with and the rates, please let me know. I'll be more than happy to help, give some insight. Have a great, productive week, and we'll talk to you soon. Bye-bye.